So today we'll be talking about Chapter 24, Section 3. And the big idea here is that political and economic institutions evolve to help individuals and groups accomplish their goals. So perhaps the politics here comes down to, should we be purely laissez-faire? Like President Coolidge once said, the government is not an insurance broker to the poor. Or should the government be more involved in the free enterprise system? As President Wilson once said, without the watchful, resolute interference of the government, there exists no fair trade between the business and the individual. So perhaps the truth is somewhere in the middle, but differing political opinions surrounding the amount of regulation is often where the disagreement comes in. Because I think most people would agree no rules is unsustainable. And again, I can go into multiple examples there, but there's the opposite extreme. Some would argue that too many rules is also stifling and problematic. And so where do we land on this? So the next question is, how do you start a bank? I mean, in theory, it could be as simple as just having enough money to loan. You know, I've just overheard conversations between some of you guys. You do loan each other money from time to time. So what if that became such a common practice that you began to charge interest? I mean, it's probably crossed your mind at some point, man, so-and-so's borrowing money all the time. I need to start charging them interest. Well, congratulations, you have become a bank. That's what a bank is. Now, the reality is you're not allowed to be a bank. You can lend money, but to profit on that is called usury, and it is illegal because to be a bank, well, you have to play by certain rules. And so we're going to talk about the services that banks offer for millions of different people. So first off, what is a bank? It really just is an investor. And what do banks need? They need depositors. So if a bank is an investment group, well, then their product is the money. And that's the commodity that they are going to use to make more money. But they need money. And that's the beauty of a bank, is we are willingly giving them money to hold on to. And then they are taking that money and profiting with it. It's a pretty sweet business model, as long as it goes well. But yes, they need depositors. So that means the bank needs you to put your money in there, needs you to individually choose to put your money in there. If that doesn't happen, the whole system falls apart. If that doesn't happen, then loans aren't issued for houses. People can't get cars unless they can pay cash. If everybody kept their money in cash, well, then in theory, the system would fall apart. So why do they do it? Why do they hold on to your money? Well, they're going to invest that into car loans, into house loans, into small business loans, into personal loans, into credit cards. Perhaps are the most lucrative form of this. And so a lot of your banks also own a credit. And so in theory, your money in your checking account is actually going to someone using their credit card at the store. Maybe they shouldn't be using that credit card at the store. Maybe they're on the verge of bankruptcy. Well, that's pitiful. But that's not your problem. You're putting your money in the bank. You expect it to be there. But they're lending that money to someone who has a bad history. And that person's about to spend a bunch of money on a credit card they can't afford to pay. But nonetheless, the system works because your money's still there. I mean, in theory, like withholding a certain amount. So there's a couple different services they offer. First are checking accounts. This is the most common. This is the one we use most often. This is where my salary automatically is transferred into my checking account each month. And then from there, we pay our bills. And as things come up, we do all of that. And then we run a pretty complicated formula, and then we put a certain amount of that into a savings account. Yes, ma'am.
How does getting approved for a credit card even work? Because it's like, when
Mm-hmm.
So it's like when they sign up for the credit card, they have to like go through like all of these like approval things, right? But then you have stories like Anna Delvey, who just like took all of these credit cards out and never paid for any of them.
Right. Happens
So
all the
how
time.
how does that happen?
Yeah, so credit cards are a high risk investment for any investment group. So let's take Chase Bank, for example, one of the largest banks in the United States. They also have a credit card. I would imagine so. I don't know what it's called, but I'm fairly certain they have multiple forms of credit. In fact, if you go for an Amazon installment card, then that's through Chase Bank. And then, well, anyway, so credit cards are high risk investments. And as a result, they expect a high return on that investment. So that's where your 30% interest comes in. But they're making high risk investments and they know that. Well, if you're talking index funds, let's say your retirement, your IRA or 401k, there's going to be a certain percentage of your retirement, and this is mostly automated at this point, that will be involved in high risk investments. So let's say, and you can choose the level of risk that you're willing to accept. So right now, mine is on aggressive risk. And so what that means is that a larger portion of my index fund, my mutual fund, a larger percentage is going into high risk investments. And I don't know what those are, but credit cards are an example of this. Now I offset that risk, or at least the computer does this for me. I offset that risk by having enough money in safe investments, meaning like bonds or Walmart or something like that. I don't know. Again, the computer does all that, but banks work the same way. So they've got a number of credit cards, and by law, that must only represent a certain percentage of their money, and then the rest must be in safer forms of investment. Does that make sense? So, for example, you know, young professional couple, great credit score, solid jobs, apply for a mortgage. They have a wonderful credit score in excess of 800, so they're a safe investment. And the bank is going to give them the mortgage with a favorable interest rate. And then you've got Sketcho Magetcho over here applying for their fifth credit card, who's about to be approved even with a substandard credit score. Well, they're about to be approved because the bank is taking a high risk, expecting the high return. Because who knows, Sketcho Magetcho may sober up, they may get their life together, but they're still going to have to pay that 30%. Yes, ma'am.
But it does like check your credit score, right? When
Absolutely,
you
yeah.
apply for a credit card.
Yes.
So it's like when you have people with like terrible credit scores, why are they getting credit cards?
Good
Why
question.
are they making that investment? And it's like pretty obvious that they're not going to pay.
Yeah, I mean, a terrible credit score, you might still be denied. But the threshold for approval is lower with credit because the banks are accepting that level of risk, in return getting the higher level of return. Does that make sense? So for a home loan, you might need 750 or higher, whereas for a credit card, you might be able to get away with 600 or
Is
so.
that why credit cards have like spending limits so that like you can't just like run the bank out?
Right. So they have a spending limit because they're willing to take that level of risk on you. The higher the spending limit, typically the higher the credit score, and also the higher the risk for the bank.
So like when they talk about like the fancy cards, or like people be like, oh, like I have like a black chrome something card.
Mhm.
Like, does that just mean I have like a really good credit score and like the bank is willing to like let me spend all their money or something?
Right. So Amazon has two levels of store credit. One is, we'll call it the fancy store credit, which you need a higher credit score to qualify for. It has a few extra benefits, and I think they pay you $200 to open that account. Then meanwhile, they have their mid-tier, and it's easier to qualify for. It has fewer benefits, a little higher interest rate, but it's easier to access. And so most of us likely wouldn't qualify for the fancy one. And the reason they're offering all those incentives is that is a safer level of risk for them. It is still a credit card. They will still pay crazy interest rates. But given that the barrier for entry is so high, it's a safer risk for them. Still high return. Okay, so savings accounts, meanwhile, are safe investments, and you are guaranteed that your money will be fine. There is no risk to the principal, as long as the financial system of the United States continues to exist. So your savings accounts, like your checking accounts, are backed by the full faith of the U.S. government with the FDIC. CDs are the same way. You put money in a CD and it's safe. Nothing will happen to it. And the difference between a CD and a savings account is with a CD, you are agreeing to not touch the money for a set amount of time. And then savings accounts you can access, but only a limited number of times per month.
Is the college fund that you talked about, like the one that you have for your son,
Mhm.
is that a CD?
So that's called a 529, and I recommend that every one of you guys set one up. Look into it. It's a federal program called a 529 college savings account. If you don't have one already, you should, even if you're looking at university a year from now, because here's what it offers. Number one, zero risk to principal. It's a federal program. Secondly, it's a mutual fund. And so if you're talking about saving money for college, it's going to be your best return on your investment. So mutual funds tend to average around 7%. And then here's the sweet spot. It's tax sheltered, meaning you pay no taxes on the money that you put into your 529. So we just filed taxes. We got to write off every dollar that we put into Avery's 529.
So are those accounts similar to a CD then? Because it's like you don't take the money out until your kid goes to college.
Well, it's similar in that sense, but CDs have no strings attached. The only condition is you put your money in there and you can't touch it for a year, and then some have longer terms. There's a few conditions with the 529. First off, all those sweet deals that I just mentioned, but, and here's the important part, it must be used for your education, or it can be rolled over without penalty into an IRA. So we're betting that Avery will go to college, even though he's 6 and says he doesn't want to. But we're still like, you're going, kid. You don't understand yet. You're going. But let's say he gets to 18 and he decides he really doesn't want to go. Okay, I mean, that's his right. He's a free human. He can do that. Well, in that event, because we're going to put money in there every month until he reaches 18. So he can choose his own path. If that's the case, then we will roll it over into an IRA for him. And then when he retires, he will be able to withdraw that penalty free. But let's just say he says, no, I just want to take that money and travel. Well, he's 18. It is his money. It will incur a hefty penalty, meaning he will have to pay something around $10,000 to $15,000 to pull it out. Yeah, so 529s are smart if you are going to use it for your education. And then even if, let's say, a year from now, you don't, then you can roll it into an IRA. So banks make loans using deposits. And that means you are giving them your money. Mine just magically pops into the bank every month. And then they are taking that money to issue loans. And then that increases the supply of money in the economy. The more loans that banks issue, the more money in circulation. So if you were saving money for college, which again, I'm suggesting use the 529. But of these options, the silliest one would just be to put it in cash, because banks do offer services that are in your best interest. The idealized version of the free market is when it's a willing exchange where both parties benefit. And then used correctly, banks can be that. You are giving them money to invest, sure. But with the options offered, you will benefit and they will benefit. It's a win-win. It should be. So the next piece is that banking through history has changed. It is a much safer system now, because once upon a time, there were little to no regulations. And banks, once upon a time, were called trusts, is another word for banks. Why? Because, when you put your money in there, you are trusting that institution to safely hold on to that money for you. It hasn't always worked out that way, unfortunately. So the first national bank was chartered in 1791, and oh my gosh, that was some drama. So Alexander Hamilton wanted the Bank of the United States. If you've watched the movie, that was a part of the debate. And then meanwhile, Thomas Jefferson hated the Bank of the United States. Andrew Jackson later killed the Bank of the United States, and it triggered a massive financial collapse in 1838. But the National Bank was supposed to be the Bank of the United States. That was the fund for the federal government. We now have that again. It's called the Federal Reserve, and that dates back to 1912, because from 1838 to 1912, well, things were a bit of the Wild West. So the National Bank supplied the federal government. It was the one who collected fees and made payments on behalf of the federal government. It was controversial. I mean, Andrew Jackson once said, quote, "The bank is trying to kill me. I will kill it." Direct quote from President Jackson, our 7th president of the United States. I mean, yeah, I can't really get into the politics there, but it was a thing that happened. So the Bank of the United States was killed by President Jackson. And then instead what he wanted was for each state to run their own banks. These were called pet banks. And so each state ran their own banks for a period of time. And not every state ran their banks the same way. And not every state ran their banks in a fair and ethical way. And so it fell apart. Yes, ma'am. That was just, if I had to guess, because I mean, I can't really identify with that word either, but I'm guessing that's what the critics called it, is that people were so mad at Jackson that they actually created a different political party because of this. The Whig Party existed because of their opposition to his plan to destroy the Bank of the United States. So it's a big deal. So when the charter lapsed for the Bank of the United States, again, this was under the presidency of Andrew Jackson, it went away. So, yes, privately owned state banks were the ones that ran currency, all the way up to through the American Civil War. So, during the Civil War, there was a need for a more stable financial system, and so the National Banking Act was passed in 1863, which in a sense rebooted the Bank of the United States because a uniform currency was needed, and the amount of money that was being spent throughout the American Civil War was a paradigm shift, meaning that it was just changing things in a big way. The federal government expanded to a massive degree because of the Civil War, and so to finance all of that, a more uniform system was necessary. And so, thanks to the National Banking Act, we are back to a system of federally chartered, yet still private banks. Yes, banks are a private business. United Community is owned by a CEO. Well, it's owned by investors and ran by a CEO. It is a corporation, just like other banks. I mean, my aunt in Chicago works for Fannie Mae, one of the largest banks in the United States, and it's a business. And she has to report to executives, and they have to report to shareholders, just like any other corporation. They exist to make money, and they do, as long as it works well. So there are a few cases of collapses. And we'll start with the Panic of 1907, because there's a handful. 1838 was a big mess. We already talked about that. And then there was 1893, when the railroads became so large that when they failed, it collapsed the economy. We still use the term too big to fail as a reference all the way back to 1893, Panic of 1893. But we'll start here with the Panic of 1907, because that's the one that resulted in the system that we currently have. So once more, bad banking practices led to collapses, and the Federal Reserve Act was passed, which created the United States and the Fed, the ones who do all the monetary policy stuff we talked about yesterday. And then the Great Depression happened. And so, stock market crash, October 29th of 1929, and the Depression lasted through most of the 1930s. Now, most would agree that around 1937, the Depression was over, but the recovery is going to last through all the way through. Really, many would argue that it was the Second World War that actually officially ended the Great Depression and launched the United States into a period of economic prosperity. So, there's a bit of politics surrounding the Great Depression, and we got into this in more detail in American history. For one, President Herbert Hoover, a conservative Republican, was in power when the stock market crash happened, and then he took one approach, and then people didn't like that, and they elected instead President Roosevelt, who had a more progressive, liberal approach to economics. And so Roosevelt, first act as president, closed every national bank, every one of them. Every bank in the United States had to close. Basically put the entire economic system on pause. And then the idea there was only banks that were financially sound could reopen, and then those banks would be insured by a new entity called the Federal Deposit Insurance Corporation, the FDIC. And so now every bank has on the homepage of their website, backed by the full faith of the U.S. government through the FDIC. So that's these guys. Yes, ma'am.
So did they just like audit every single bank in the country, or was it like dependent on the banks to like prove that they were financially stable?
So did they audit every single bank on the? I don't know. I don't remember that process. Honestly, all I know is.
Trust that if you reopen, then you're financially.
Oh no, I would imagine they put very clear rules in place. That you had to be this, and perhaps a minimum amount of money in reserve, perhaps a clean ledger, no outstanding debts or something like that. And when they got to reopen, now full faith of the federal government, people cautiously began to use the banks again, because, well, the Great Depression was the last straw for a lot of people. And they took their money out of the bank, and a lot of people for the rest of their lives never used banks again and only used cash. And I mean, there were a number of folks, my grandparents included, who didn't even trust cash. And instead, when they had money to invest, they would put it into gold. So here's a neat thing. In fact, there's a number of rather predictable investment opportunities. One is, well, if a Democrat is elected in the White House, invest in guns, because for whatever reason, I'm not talking about buying guns, but I'm saying invest in that sector of the economy, because there will be a spike. Everybody panics, oh my gosh, and then everybody goes and buys those things. True story. Yeah, look at it. It's just a blip, and you can buy prior to the election and then sell at the peak, which is going to be a few months after, because eventually people will realize, oh, it's not happening, and then stocks will go down. And then, same sense, if a Republican is elected, actually stocks and guns will go down, because not as many people are rushing to buy them because they feel more confident. Here's another fun one. I forgot the other one. It'll come back to me. Oh my gosh, I really did forget. Okay, it'll come back to me later. Anyway, let's get into a bit more closer to the present. The savings and loan crisis, and this was around the time I was born, was because banks were making too many high-risk loans. Oh, yeah, I remember it now. If there's a bad recession, invest in gold. If the economy is strong, that's when you want to invest in gold, because the value of gold is low. If there's high confidence in the economy, there's not as much gold being bought. When the economy is in recession, that's when to sell, because the value of gold is higher. It's a weird thing, but it's true. Okay, so why did the 1980s and early 1990s represent the worst recession until 2008? It's really the same story. Banks were engaging in high-risk loans without regulations. Guess what? High-risk loans sometimes end badly. Big surprise there. And too many high-risk loans, and you're out of luck. So that's why an index fund is a smart move, because yes, it does have some high risk loans, high return, but it generally hedges bets with enough safe loans so that, yes, your index fund will go up and down in value, but it won't just crash. But that's what happened here. And so in response, the FDIC took over regulations of savings and loan institutions in addition to banks. All right, so now I want to get into a couple of laws here. The Gramm-Leach-Bliley Act, passed right before the new millennia, permitted bank holding companies greater freedom to engage in a full range of financial services, such as, of course, banking, but also insurance, as well as securities. So this means that banks can get into the insurance business. Insurance is another potentially high-risk investment. But what are insurance companies? They are essentially banks. So right now, our car insurance carries a policy of up to $100,000. And the theory with that, and our person said that's the lowest they would allow, because if there's a pile up on 26 and it's your fault, that could cost $500,000. And so it's not as simple as just a car crash and then replace the person's vehicle. So again, $100,000 tends to be the barrier of entry. But to get that $100,000 of insurance, we have to pay. And they take that money and then they hope that I never crash my car. Now they're hoping, but the reality is it could happen. But enough people don't crash their cars, meaning enough safe investments to offset our 16-year-old drivers who are more likely to crash. You guys are high-risk investments for insurance companies. High risk translates to high return. Then you have folks like me who have been driving for 20 years. I tend to be a lower risk investment when it comes to driving. Haven't had a significant crash in 20 years. So yeah, pretty safe driver overall. So low risk for me, low return on investment, hedging bets by keeping folks like me and then putting a portion of their money into high risk folks like you. Can do that just like insurance companies can.